Welcome to Wealth Beyond the White Coat, a show where we dive deep into the world of financial freedom for dentists and medical professionals. I'm your host, Darren Flesher, a dentist with a passion for uncovering the strategies that lead to a prosperous life beyond the office. Every episode will explore the avenues of alternative investing, tax mitigation, and secrets to build wealth that the textbooks don't teach you. Whether you're looking to enhance your financial literacy, discover new investment opportunities, or simply find a better way to manage your money, this is the place where your financial health is the core of our conversations. Welcome to Wealth Beyond the White Coat, where your journey to financial clarity and freedom begins. Okay, welcome back. So we are right around 20 episodes in now, and wanted to do a little housekeeping again here first. Just wanted to let you know a couple things. So if you feel like you or someone you know would make a great guest on the show, please email me at darren@legacypointgroup.com. That's DEREN at legacypointgroup.com. We'd love to continue to have a variety of topics and guests as it relates to finances, especially above and beyond the income generated from your practice. Additionally, and also similarly, if you have a product, program, or service that you'd like to have more people know about, and you think and you'd like to sponsor the show, please also reach out to that email address, and we can chat about packages to get your name out to more of your target audience. So with that, let's get to the show. In today's episode, we're getting back into due diligence with a special guest. His name is David Sangstock, and he's the president of Mick Law. Mick Law has been a pioneer in the due diligence ecosystem for about 2 decades, helping to ensure that alternative investments are vetted thoroughly. So today, we're going to explore some of the elements of evaluating a deal from start to finish, including the importance of checking out the individuals involved, the deal itself, and any tax-related components. So today's episode is a must-listen for anyone involved in or considering alternative investments. Let's get to it.
We have a special guest today, David Sangstock. He's the president of Mick Law. Mick Law is a law firm based in Omaha, Nebraska, and they are the pioneers, if not creators, of the due diligence ecosystem in the alternative investment industry. They've been doing this for well over 20 years, and they are considered the gold standard. So we're very excited to hear David talk today.
I appreciate it, Ross.
Yeah, welcome, David. We were talking before the show. A lot of what we want to touch on here today is that third-party behind-the-scenes stuff that goes into making sure a deal is good from start to finish, A to Z, that we've checked out the individuals, the deal itself, and then if there's a tax part of that, we want to make sure we touch on, make sure that's going to check out and check the box when we file our tax returns. A lot of what we're trying to do here is we want a good return. We want a good investment. Obviously, that has to be the first part of what we're trying to do and make sure that everything is real with the asset and everything performs. But sometimes some of the deals we're looking into have tax benefits as well. And if we're going to try to claim that, we want to make sure that it actually would be backed up. So we want to make sure we touch on some or all three of those parts today: individuals, the deal, and the tax part. I'll kick it off here with into what we want to talk about here today. I guess, when you're looking at a sponsor's track record, like how do you evaluate a sponsor and how do you go into looking at a deal, if you want to start there?
Yeah, I think just to do a little preface before that, Darren, I think it's important for people to understand where this this concept of this idea of due diligence started. Because I would say 20 years ago, and we're only talking about a small minority of groups that are raising capital through the private channel that actually have any group do any kind of third-party due diligence. A lot of times a broker-dealer and investment advisor might do it internally, but a lot of them they follow the structure of the FINRA notice, which was 0548, which basically talked about the ability of a third-party due diligence provider to come in and work alongside the investment advisor or broker-dealer to do the due diligence on a specific offering or on a sponsor and the like. So really that kind of started the idea that, hey, we don't have to do it all internally. We may not have the capacity internally to really look at all the different types of offerings that are out there. So can we rely on an expert that might be able to provide us a reasonable portion of our due diligence requirements and do that in a more efficient and probably educated manner than maybe what we're able to do internally. So that's where the third party due diligence started. And some broker dealers really took off in the early to mid 2000s with utilizing third parties to help them through that process. And we were obviously one of them. That's where it fit in. And believe it or not, regulators, a lot of just still don't really understand where we fit into it. It takes several steps of learning for them to see where we fit in, that we don't represent the sponsor, that we're actually representing the broker dealer investment advisor. That takes some time. A lot of times when things go sideways and they start looking at different groups that were involved in some way or another in the transaction itself or the due diligence process. I don't want to get off the beaten path, but I think that's where third party side of things started. And I think there are a few other groups that do it. I think there's a couple law firms that do it, which I can get into why I believe the law firm is probably a better route. But then there's also some other due diligence providers that do SWOT analysis, stress testing, for instance, on specific offerings that once again, a broker dealer investment advisor can use that in determining whether or not such an offering or sponsor is something they want to put on their platform or then sell to specific investors. As a law firm, we're a little bit different, right? We have obligations to our clients. So our broker dealer or the investment advisor is our client. So we have a fiduciary duty to them. We have specific attorney-client privileges that don't exist, that law firms don't have, that a group that isn't a law firm doesn't have. They really just don't really have any duties to anyone, to be honest. They sure aren't required by any bar association or any group of which requires them to hold things in confidence. So I think that's important, because if I have a client call me that wants to know something more than might be written in within my opinion I put together, I am open to having that discussion, knowing that it's going nowhere between the two people talking on that phone. So I think that's very important for that client to know that they can come to me and I can tell them what I think, and no one can ever tell me that I have to disclose what that conversation was. So that really helps out. I think a broker dealer or the due diligence officer within that broker dealer or investment advisor who sees that duty that I have and that obligation I have to them as a fiduciary to make sure that everything stays in confidence. So that's where I believe the law firm kind of fits in on this. One thing we do a little differently too is we put together what we consider a legal opinion. So it does get into the pros and cons of the offering, but we also kind of, if we're able to, give a reasonable conclusion that it isn't something that we would not want to see a client of ours put on their platform. Obviously, there's some internal stuff they have to go through in determining whether or not it goes on their platform. But at least from the outside looking in and going through the documents and how they're written and all the third-party reports, we feel that we're comfortable with them if they decide to put that on their platform. That's the opinion that we're going to give on that, which is different than maybe just doing a pro and con analysis or SWOT analysis and then just putting it in your hands or the broker dealer's hands to make a decision whether or not that's something they want to do on their own. Really do that, and we really want to focus on the structure. What's in a specific offering? What are the investor rights? How are they valuing the assets or the shares, the financing components, the exit analysis? These are all things that we do on our own. We're independent of what the sponsor provides to their investor or to the broker dealer. So we'll want to create our own underwriting of a specific offering. But that gets to the offering side. So let's get back to what you mentioned, and that's the sponsor.
Hey, I just want to interrupt real quick and say thanks for listening to the podcast. If you didn't know, we have an associated Facebook group also called Wealth Beyond the White Coat. Over there, you can ask your questions, get feedback from group members, and have a close community of medical professionals who are likely interested in the same things as you. Whether it's alternative investing, tax mitigation, ways to keep more of your money, or even protect your assets, we're going to discuss those things in the group. Additionally, we have a private investors club called Legacy Point. As a member, you'll get exclusive discounts to preferred vendors, and you'll get access to private investments that you'll find nowhere else. Whether it's hotels, apartments, oil and gas, equipment rental, you name it, we'll be discussing those details and offering those investments to members only inside Legacy Point Group. If you want to learn more about that, please contact me or simply email info@legacypoint.com. That's info@legacypoint.com. at legacypointgroup.com or go to the website legacypointgroup.com. And Wealth Beyond the White Coat podcast listeners get an exclusive discount if you use the code WealthBeyond. That's all caps, all together, WealthBeyond at checkout. I'd love to have you in the group, and I'd love to see you making more passive income as you move towards financial freedom, whether it's freedom to retire early, spend more time with your family, go on more vacations, or just do more of what you love while you're in the operatory. I'd love to see you doing that as part of Legacy Point. So here's to improving your financial health. Before we even do that, actually, let's back up a little bit. Tell us a little bit about Mick Law, the history there, who you guys are.
Yeah, sure. No, yeah, that makes sense. I know we talked earlier on it, but to get into it now that we're full into the podcast here, we are a law firm that started back in 2005. 2004 was actually the first year in which our previous and the Brian Mick is who the Mick Law is named after. He started the firm back in 2005. He started doing due diligence on behalf of a few broker dealers back in 2004 and wanted to expand that business. And to include more sponsors, more broker dealers, more investment advisors. And his firm at that time just really didn't want to put the capital out there to create a functioning due diligence portion or sector of their law firm. Brian Mick decided to create his own law firm at that point, and the rest is history. We started to look initially at mostly real estate in the form of tenant in common, 1031 transaction-based offerings. And then that spread into more and different types of real estate offerings. And then that expanded into the energy space, which then expanded into the private equity space and looking at basically anything that's being raised under the private placement Reg A, Reg D. The requirements are different, obviously, from a publicly traded company for the groups that raise money this way. But we continue to offer our advice to our clients within that sector of offering opportunities. And so that basically I always say, think of private companies raising private capital. So anyone in that kind of sector is what we're looking at. And we've continued to do that. And now we're at 9 attorneys and 3 paralegals. And we have our own geologists and experts in the petroleum engineer space, as well as our real estate underwriters, which we have on our team as part of our due diligence process, as well as the other administrative staff that we need to have at our office. But we are based here in Omaha, Nebraska, and our vice president of business development lives out in Huntington Beach, or is it Manhattan Beach? Why do I always forget which one it is?
I think I'd rather live in Manhattan Beach than Omaha, Nebraska.
Yeah, that tells you how often I've been out to that small little office we have there where Zia Sabir, our business development vice president, resides. Yeah, it's a national type representation. Our clients are broker dealers, investment advisors, family offices, pension funds, trust companies that utilize this space as a portion or a portion of their portfolio. And they want to invest a certain percentage of what they're putting in to the securities marketplace into private offering opportunities. They utilize us to help them get through that due diligence process. And that's where we've been since at least 2005. I started in June of 2006 and then moved to Omaha in early 2007 and have hit the ground running ever since.
Awesome. Thank you.
You said something that kind of sparked a question that Mick Law was born out of broker dealers and investment advisors that were going to offer alternative product, being able to outsource the due diligence function because they didn't have the capabilities per se internally to do it themselves. Right. I think one of the issues that, and Darren can speak to this, is a lot of the products that are being sold today through guys that have podcasts or YouTube channels, a lot of them are using social media and they're going direct to customers, but they're sponsors going direct to customers. So they're not going through an investment advisor distribution network. They're not going through a broker dealer distribution network. Those licensed professionals have a standard to do due diligence. That's why they're outsourcing it to somebody like you to make sure that it gets done in a best in class way. But any of those sponsors that are using social media today and going direct to customers, they don't have that same, and this is a question, I'm assuming they don't have that same standard for having due diligence upon themselves because they're not going through the SEC or through FINRA as a distribution mechanism, whereas the brokers and the advisors do have that. Is that Can you speak
Yeah,
to that?
I think that's fair. Yeah, I think they're able to raise capital in whatever means that they believe is sufficient and meets the requirements under however their filing is. But in reality, the vast majority of even investment advisors really conduct their own internal due diligence on a product, and a lot of times they don't necessarily know what they're looking at. They just know that they've been provided this private placement memorandum and exhibits and have been told that this is a good investment opportunity. And a lot of times it's provided them from an investor itself. Hey, my buddy gave me this investment opportunity. Here's the book that he gave me that was put together for this offering. I want to invest in this. What do you think? And and a lot of times the investment advisor does. They go through it. It looks like it makes sense, so they'll put their client in it. I just don't necessarily think that meets the requirements of doing functional due diligence, especially as a fiduciary, as an investment advisor, really looking into what it actually takes to do due diligence on a specific offering or a sponsor to get that comfort level. They don't want to they don't want to frustrate the client, the investor. So if the investor says they like it, they're going to probably let them go into it and then maybe have them sign off on something or come to the conclusion they think it's a fair investment opportunity and move on, not knowing really if it is or isn't because they haven't compared it. They haven't compared to any other product that's out there.
I've seen advisors invest in some of these direct to retail funds that turn out not to be good, and they have to get it approved by their compliance department. Their compliance department has no idea what they're looking at. I've seen banks finance these deals, and these banks have no idea what they're looking at. The reality is, in my experience, unless you're a trained due diligence person, that you typically have no idea what you're looking at. And and then at the same time, a lot of these direct to retail guys, they'll, what I'll say, hide under a sponsor's exemption. So talk about that for a second.
If a sponsor is raising capital through their own network, they don't necessarily, they're usually have established relationships, and therefore they can raise capital through those relationships and wouldn't necessarily be doing the same thing that an outside broker dealer or investment advisor would want to do. You better have an established relationship with these groups to really feel that you should put capital with them without really doing any due diligence other than having a pre-existing relationship with a sponsor.
Hey, I just wanted to interrupt the show real quick and tell you about an exclusive member discount for Legacy Point Group members. The company is called Gelt, and they're both tax planning and tax preparation. We connected because their CEO actually comes from a family of physicians, and he understands the financial complexities that healthcare professionals face these days. Legacy Point is honored to partner with Gelt because it's our shared mission to empower successful professionals with optimal tax and financial outcomes. For your 20% discount off financial planning and tax preparation and priority access with their onboarding, become a member over at legacypointgroup.com. Going on what Ross said, I've seen some of these Facebook groups and deals that are direct to consumer or aggregated by group leaders, direct to a Facebook user. And I see them go do what they would call due diligence. And that might just be flying out or driving out to a site, counting the number of doors on an apartment complex, or making sure that they've got working AC. And that's obviously part of what you should do. But I assume there's a lot more to checking into the deal level of an opinion than just seeing that it exists. And so whatever you're willing to share without giving away any secret sauce to what you guys do, like what goes into due diligence besides physically seeing that this thing exists and is real in that regard?
Yeah, I think I would say on any good year, this is a little different. This year might be a little slower, but it's anywhere between 15 and 22,000 Form D filings are filed with the SEC. Those are
Explain
private.
what a Form D filing is.
All that is, you are filing with the SEC indicating that you intend to raise capital through an exemption other than you're not a publicly traded company. You're using either 506B, C, you could be Reg A. I think there's crowdfunding. There's different ways you can raise capital that don't require you to register as a public company raising capital. Think of like the stock market, right? Every one of those companies there are required to do quarterly reports, annual reporting. Functionally, there's a lot that goes into doing that. It's very costly. If you're a smaller group trying to raise capital, it would really never behoove you to raise your money through the private markets because you probably couldn't afford to even run your business. So these exemptions allow you to raise capital without having the same kind of oversight. You have certain requirements, but those requirements are nearly what it would be on a publicly traded company. So you're talking about, like I said, 15, 22,000 Form D filings seeking somewhere in the neighborhood of $1 trillion from private investors. Our firm might look at somewhere between 20 and 25 billion. So just from a really microscopic look, it's a very small amount of what's being actually filed. And just because they say they want to raise that capital doesn't mean they're going to. But the simple fact that there's that many filings and such a few that third party groups might be looking at really leaves this huge hole of undue diligence product that's out there that you really have to go in thinking this is the Wild West. Do I really want to put my money in this? If no one's looked at it other than the sponsor or the group that's managing it, sending me a really nice little brochure that shows a really nice building that shows I can get a really nice return, and then just running with that and making your investment based upon that. So that's really what happens in the vast majority of this. And then when things go wrong, people wonder why. And no one's perfect, but I think the more research and due diligence that you're doing on a specific group and a specific offering, the less likely you're going to run into those problems. Doesn't mean they won't, because there's always going to be people that make, there's bad actors, people that just make a bad decision, and you can't control all that. But what you're trying to do is getting to a functional state where you believe that you've looked at this investment, the sponsor, you've gone through the hoops, and you believe that they can be successful, and that there's no red flags or glaring issues that should keep you away from it. That happens at both the sponsor level as well as the product level. And so really, when you're looking at the sponsor side of things, do you want to start with sponsor, or do you want me to start with the product?
Let's run with what you just were talking about with the brochure and all that. Like, how do you guys evaluate a sponsor's ability to execute the plan that they're showing us?
Yeah. So when you're talking about a sponsor, which you got to start with, right? Because if you're looking at a product and you think the product's good, you better know that the sponsor's good first. Right? So the first thing is to get through an understanding of where the sponsor fits. And so by doing that, we're going to send out a checklist to a specific group. We'll call them a sponsor. Not everyone knows what a sponsor is, but a lot of people in the investment advisor world think of an asset manager. The asset manager is the one who's running with it and making sure and managing the investment on behalf of the investors. We call them sponsors because they're putting together multiple deals, maybe a year.
Would that typically also be the GP in the deal, general
partner? Could be the GP, correct. It could be a general partner on an LP structured offering where they have the management controls and they're really running with it, which is what makes it a security, right? Investors are coming in and they really don't have any say on how on a day-to-day that product and that investment's going to work. They are putting their full faith and credit into that group, that sponsor, that asset manager, that general partner to execute on the business plan. So when you're looking at a sponsor and determining whether or not they are even a group or it is a group that you want to do business with, it starts, first of all, background checks on all the individuals. Anyone that can make a decision, any entity that's involved, doing that, making sure they're formed correctly. The individuals don't have any background issues. Sometimes you'll find security violations on the individuals. They could have been in jail before. They could be a criminal. And a lot of times that stuff they won't disclose. They're supposed to, but they won't disclose it. We're going to look for that. We're going to look at regulatory history on the groups, make sure there isn't any historical issue as it relates to filings with the SEC we're going to look at their organizational structure and the controls. Who's making decisions in the firm? Some of them are small, right? It's four people running the show, and that ultimately one guy put in all the money, and the other ones have a small ownership interest. But ultimately, we know that guy that owns 95% is probably making all the major decisions. So we're going to look at him, and we're going to make sure that he's got the background historically, operationally. Has he done this before? Has he managed a similar type product? And if not, I'm not talking about something that's just in a private placement offering that's being sold to investors. He could have been with a large global firm that has invested in billions of dollars of multifamily properties over the years. And he's been actively involved with that. So we know he can find assets, and he's been involved with that. Now we got to make sure that he can take that and run with the requirements and what an investor wants to see on a private placement side of things. So we're going to look at his background or her background or the group that's running the decisions and make sure that they have historically been able to do it. Do they have prior performance in the year? Have they done this before? It's not a get good. If they haven't done it, that doesn't mean that they can't do it. Just means that if someone has done it and they've done it before, at least it shows that they have the aptitude to fulfill it. Doesn't mean they're going to, right? Prior performance doesn't mean that you're gonna be able to come out on top this next time around. But a good prior performance at least shows that they've been able to find assets that work or develop properties that work or whatever it might be. And so that's obviously important. We're going to get references from them. Normally we get a couple CPA firms, we'll get a couple law firms that have worked with them. We'll ask for a few investors that can at least speak to how their relationship has been as it relates to getting communication from that group. Are they getting monthly updates on how the investment's progressing? We're going to find out, talk internally to the individuals that are responsible for investor communication, make sure that what happens when you make a phone call? Do you get a recording, or does someone answer the phone? How quickly do they get back to you with a question you might have? It's all important, because if investors are asking questions and they're not getting answers, it's human nature. You think something's going wrong. So being responsible to your investors means communicating with them. So we'll look and make sure that they are reasonable with their responses in the past. We're going to look at the capabilities, like I mentioned, a little bit more of everyone that's in the management and staff, and what their job obligations are. Can they do that? Have they done in the past? A big one's policies and procedures. A lot of them will have accounting procedures or policy procedures on internally how the decisions are made, or how are checks written, right? If it's anything over, say, $10,000, does it require two people to sign off on it, so that you don't have one individual that has over-encompassing control where they could be a bad actor and steal an investor's money, for instance, without anyone knowing, because there's no controls on how those checks are being written or the controls of the money. What are the protections on the investor information? Are they locked in a lockbox? Are they in some kind of portal that requires a password and username to get any of that information? Financial statements, right? Let's look at the financial statements of that sponsor entity. What does it look like? Can they continue to operate as a going concern if things go a little bit sideways? Doesn't mean it's not gonna work out, but can they continue to operate if they don't do another deal? Do they have enough money coming in, or have the capital from the owners that can the office open and running through the term of the offering term of the specific deal? Disclosures, we're going to go through that. Prior performance review and disclosure. That's a pretty good handful of what we look at. Obviously, business plan too, making sure that if they say, here's what we're doing, and then you get their offering and it's completely different. That happens a lot, right? They can't stick to what everyone thinks, okay, this isn't the sector I want to be in now, so I'm going to pivot to something different. Okay, that's not even what you're known for. That's not what your background is. Why are you pivoting to that, other than you think it's an easier way to raise capital because everyone's going to that asset class? That's really things to be looking out for as an investor. If they can really make changes in how their business plan and what their objectives are, that can be a problem. That can show that they're not in tune to what their capacity is and zeroed in on what's going to be their best opportunity to make money for you.
So some of that stuff's really black and white. If you've got a legal history, the bankruptcy, something like that's going to jump off the page. But I imagine there's some more nuanced stuff where it's maybe you have a subjective opinion on, like, some of those things like answer and did they get back with you? And I assume you guys have some of that stuff that you run across that you might have an opinion on, or maybe interests aren't aligned, the way people get paid. Can you share some of those, how you guys weigh in on that, or if you don't, and what that looks like for you guys in your process? Okay, that wraps up the first part of our conversation with David Sengstock. We covered some of the foundational aspects of due diligence, from evaluating sponsors to understanding the importance of a thorough background check. But there's much more to discuss, so in the next episode, we'll dive deeper into the complexities of conflicts of interest, markups, and what red flags to watch out for when assessing investment opportunities. So be sure to tune back in. You don't want to miss it. Thanks for listening in to Wealth Beyond the White Coat. Your time and attention mean a lot to us. If you found value in today's episode, please consider leaving us a review on your favorite podcast platform and share it with your colleagues and friends. Your feedback helps us grow and reach more professionals like you striving for financial freedom. Until next time, keep pushing the boundaries of your financial health. Thank you for joining us on this journey to wealth beyond the white coat.